The housing collapse people keep expecting hasn't arrived with a single loud crash. It's already underway, just unfolding unevenly and out of the spotlight. Despite reassuring headlines that suggest the market is holding steady, more than 100 large housing markets across the U.S. are already experiencing declining prices. In several cities, available listings have surged by 30 to 40%, pushing supply far ahead of demand. Home equity is shrinking fast, and in parts of Florida, close to 1 out of every 10 homeowners now owes more on their mortgage than their property is worth. This isn't some future prediction or worst-case scenario. It's happening in real time. Certain areas have already shed anywhere from $50,000 to $100,000 in home value in less than 2 years, while others continue to slide month after month with buyers nowhere to be found. What's really going on is a slow fracture of the housing narrative, happening quietly, unevenly, and far faster than most people are paying attention to. Number 10. Fort Myers, Florida. At first glance, Fort Myers appears steady and uneventful. But beneath that calm exterior, the data paints a much more troubling picture. Home values here aren't climbing on real demand anymore. They're being propped up by wishful thinking. Since late 2023, median prices across the Fort Myers-Cape Coral metro area have dropped by more than 7%, even as active listings have jumped over 35% year over year. That's not a temporary seasonal shift. It's a clear structural imbalance forming in the market. Here's what often gets overlooked. Fort Myers isn't a traditional housing market. It's driven by cash flow. During the boom, more than 42% of buyers were purchasing second homes or investment properties, many of them locking in ultra-low mortgage rates between 2020 and 2022. That strategy worked then. It doesn't now. Those same owners are running headfirst into a harsh reset. Short-term rental occupancy has fallen between 18 and 22%. While nightly rental rates are down nearly 25%. At the same time, insurance costs have surged dramatically. In Lee County, the average homeowner's insurance premium now tops $4,800 per year, up from roughly $1,600 before 2020. That single expense alone has erased profitability for many rentals, and the pressure doesn't stop there. Property taxes are being recalculated based on peak-era valuations, even as home prices slide lower. That creates a painful double bind. Fixed expenses are climbing while asset values are shrinking. Owners are getting squeezed from both sides. Recent listing data shows that more than 51% of homes in Fort Myers have already gone through at least one price reduction. Properties are now sitting on the market for an average of 78 days, compared to just 21 days at the height of the boom. Meanwhile, the migration wave that once fueled demand is losing steam fast. Net domestic inflows to Southwest Florida fell by more than 60% between 2022 and 2024. Retirees are pausing. Investors are slipping out quietly. Builders are responding by offering incentives worth 8 to 10% of the purchase price, an unmistakable signal that demand has fractured. This isn't full-blown panic yet, but it is late-stage optimism clinging on. Fort Myers is moving into the most dangerous phase of a downturn. Sellers are still anchored in 2021 expectations, while buyers are already pricing in 2027 realities. Markets don't break when fear is at its loudest. They break when denial finally gives way to the truth. Number 9. Denver, Colorado. Denver's housing slowdown isn't dramatic or headline-grabbing. It's precise, gradual, and that's exactly why it's risky. Over the last year, more than 90% of homes across the Denver metro area have declined in value, a statistic that barely gets mentioned because prices haven't fallen off a cliff in one sudden move. But markets rarely fail through explosions. They fail through slow erosion, and Denver is wearing down fast. From late 2024 into early 2025, home values in Denver dropped roughly 6%, with winter months seeing nearly a 1% decline month over month. That's notable because winter is typically one of Denver's more stable seasons. At the same time, inventory has been creeping higher, now up more than 28% year over year, while buyer demand continues to thin out. Homes are sitting for an average of 62 days, nearly 3 times longer than during the pandemic-era peak. What rarely gets discussed is who was actually driving Denver's boom. It wasn't local families. It was remote tech workers and high-income transplants relocating from California, Washington, and New York. That wave is now reversing. Return-to-office mandates are pulling workers back toward the coasts, and Denver doesn't offer the salary premium needed to keep many of them anchored. The result is outmigration combined with mortgages locked in at peak prices. Then come the rising costs. In several counties, property taxes jumped 20 to 30% following reassessments. Insurance premiums are also climbing, even though Denver doesn't face the same disaster risks as coastal markets. Add to that HOA fees in newer developments, which often run between $400 and $600 per month, and affordability quietly collapses from within. Even with prices easing, mortgage payments on a typical Denver home are now more than 70% higher than they were in 2019. And the most telling signal is still ahead. Pending sales volume is down nearly 15% year over year. That's future price pressure already baked into the system. Denver isn't in free fall yet, but it's steadily losing its buyer base. And when confidence drains from a market built on lifestyle appeal instead of income fundamentals, prices don't settle smoothly. They slide until optimism gives way to math. Number 8. San Jose, California. San Jose isn't unraveling like a typical housing market. It's straining under the sheer weight of its own pricing. As the most expensive market on this list, it also happens to be one of the most vulnerable, and that irony is starting to show. Over the past year, home values in San Jose have fallen close to 9%, and the pace of that decline is picking up, even while Silicon Valley stocks sit near historic highs. Here's the disconnect many analysts prefer to gloss over. Tech valuations are soaring, but tech employment is not. Since 2022, the Bay Area has shed more than 120,000 tech jobs, with San Jose right at the center of that contraction. High-income workers aren't rushing in to buy. They're holding back, renting longer, or quietly moving elsewhere. At the same time, supply is building. Active listings are up roughly 30% year over year, and price cuts are spreading quickly, particularly in the $2 million to $4 million segment of the market. The math on affordability here simply doesn't work anymore. The median home still costs around $1.4 million, and at today's interest rates, monthly payments push past $9,000 once taxes and insurance are included. To carry that comfortably, a buyer needs an income well above $300,000, and that group is getting smaller, not larger. Another shift is adding pressure. The long-standing property tax lock-in is starting to break. Many long-time homeowners are retiring or relocating, releasing inventory into a market that new buyers can't realistically absorb. Meanwhile, trouble in commercial real estate is bleeding into residential confidence. Office vacancy rates across Silicon Valley are hovering near 25%, a clear sign that some demand loss is permanent. San Jose doesn't need a wave of panic to move lower. It just needs time. When a market relies on a narrow slice of ultra-high earners, even modest changes in employment or sentiment can cause outsized price swings. This isn't a tech boom and bust story, it's a valuation gravity story, and gravity always has the final say. Number 7. Jacksonville, Florida. Jacksonville may look steady at a glance, but it's quickly becoming one of the most misunderstood housing markets in the country. On the surface, prices appear calm and unchanged. In reality, that kind of flatness is often what shows up right before a downturn begins. Median home prices are hovering around $390,000, barely moving from a year ago. But in an environment where inflation is still running above 3%, flat prices already translate into real losses. The more important signals are below the headline numbers. Pending home sales have dropped nearly 14% year over year, a forward-looking metric that typically precedes price declines by several months. Inventory has also rebuilt to 2019 levels, effectively wiping out the pandemic-era shortage that once kept sellers in control. Homes now sit on the market for more than 65 days on average, compared to just 18 days at the peak. That shift alone flips the negotiating power. Jacksonville's surge was fueled by affordability arbitrage, buyers escaping South Florida's price tags and the tax burden of the Northeast. That advantage is disappearing fast. Insurance costs across Duval County have surged, with average annual premiums now landing between $4,000 and $4,500, more than double what homeowners paid before 2020. Ongoing flood risk reassessments and shrinking reinsurance coverage are making ownership riskier with each passing quarter. Job growth was expected to backstop the market, but it hasn't delivered. Expansion in banking, logistics, and healthcare has come in slower than projected, while wage growth has stalled below 4%, nowhere near enough to support today's mortgage payments. Investors are stepping back quietly. Rental listings are increasing, rents are losing momentum, and the cash flow equation no longer works at current prices. Jacksonville isn't crashing in dramatic fashion. Instead, it's drifting toward oversupply with no clear catalyst to revive demand. And that's the most dangerous position a market can be in. Once sellers finally recognize that buyers have already left, prices don't slide gently. They reset. Number 6. San Antonio, Texas. San Antonio's housing market isn't running hot anymore. It's cooling in uneven patches, which is often how extended downturns quietly take shape. Home prices have eased roughly 5 to 6% from their peak, and while that pullback may sound mild, the underlying dynamics are far more troubling. This has become one of the slowest-moving housing markets in the country. On average, a home in San Antonio now takes about 83 days to sell, the longest timeline among major U.S. metro areas. Sales activity is weakening at the same time supply keeps building. Closed sales are down more than 10% year over year, yet new listings continue to hit the market. That imbalance is especially important here because San Antonio doesn't have a deep pool of high-income buyers to cushion the slowdown the way cities like Austin or Dallas do. Median household income sits near $63,000, while the median home price remains close to $310,000. That gap is no longer sustainable. The local economy adds another layer of risk. San Antonio is heavily concentrated, with nearly 1 in 5 jobs tied directly or indirectly to military spending, tourism, or healthcare. All three sectors are under pressure. Uncertainty around federal budgets is clouding military growth. Tourism spending is softening, and healthcare systems are tightening hiring. Without broader diversification, housing demand weakens quickly. Builders are already flashing warning signs. Incentives worth 6 to 9% of the purchase price are becoming common, including rate buydowns and so-called upgrades that quietly mask price cuts. That's how builders preserve headline pricing while resetting the market behind the scenes. At the same time, rent growth has stalled, inventory is climbing, and investors who expected Austin-style appreciation are starting to reconsider that assumption. San Antonio isn't a market that collapses from speculation. It drifts lower when affordability breaks. And once buyers realize prices don't have to rise here, urgency disappears. That's when gravity does the rest. Number 5. Tampa, Florida. Tampa's housing downturn is no longer something you have to squint to see. It's become mechanical and unavoidable. This market isn't being dragged down by fear or headlines, it's being dismantled by rising costs. Home prices are already down close to 9% from their 2022 peak, and the slide picked up speed in early 2025 with a sharp single-month drop of roughly 1.6%, one of the steepest declines anywhere in the country. Moves like that don't show up in healthy markets. The real pressure point is ownership expense. Tampa now ranks among the most expensive places in the U.S. when it comes to insurance. The average homeowner is paying around $5,100 per year just to insure a $300,000 home, more than twice the national average. For many families, insurance alone now costs more than utilities, internet, and car insurance combined. Once you layer in property taxes and HOA fees, monthly carrying costs blow up traditional affordability models entirely. Inventory fills in the rest of the picture. Active listings across the Tampa-St. Petersburg-Clearwater metro area have climbed more than 30% year over year, and price reductions are spreading fast. Over 52% of homes on the market have already cut their asking price at least once. Properties now sit for more than 70 days on average, compared to fewer than 20 days during the boom. Even short-term rentals, once Tampa's pressure valve, are starting to fail. Occupancy rates have fallen by roughly 20%. Nightly rates are slipping, and new regulations are squeezing margins from every direction. Investors who bought in expecting non-stop tourism demand are learning a hard lesson. The math doesn't bend for optimism. Tampa didn't suddenly lose interest from buyers. It lost affordability. And when a market becomes expensive just to hold, selling stops being optional and starts becoming necessary. That's the moment when routine corrections turn sharp. Number 4. San Francisco, California. San Francisco's housing market isn't just going through a routine pullback anymore. It's resizing itself for a much smaller future. Home prices across the San Francisco-Oakland-Fremont metro are down more than 10% year over year, placing it among the sharpest declines of any major U.S. city. And yet, even after that drop, the median home still carries a price tag of roughly $1.3 million. That disconnect is the heart of the problem. The engine that once powered this market is gone. Since 2020, San Francisco's population has shrunk by more than 7%, and tech employment continues to trend lower. Office vacancy rates remain near 25%, signaling that many of the high-paying jobs once tied to the city simply aren't coming back. Without those incomes, buyer demand weakens no matter how far prices fall from their peak. Supply is rising as hesitation spreads. Active listings are up about 35% year over year, and high-end homes are lingering on the market for months. Price cuts in the $3 million to $5 million range are no longer rare events. They're becoming standard. Sellers are learning a hard truth. Even aggressive reductions don't guarantee a sale when the pool of qualified buyers is shrinking. Costs only add to the strain. Property taxes, insurance, earthquake retrofitting, and ongoing maintenance stack together into monthly ownership expenses that often exceed $10,000. Meanwhile, rent growth has slowed enough that holding property no longer makes financial sense for many owners. San Francisco isn't dealing with the aftermath of a speculative bubble popping. It's adjusting to a new reality. A city once driven by density, innovation, and relentless momentum is now facing outmigration, downsizing, and contracting demand. Housing prices don't fall because people panic. They fall because fewer people need to be there at all. Number 3. Phoenix, Arizona. Phoenix is now in the middle of one of the fastest housing reversals in the country, and the root cause is something many people still underestimate. Buyer demand disappeared far more quickly than supply could adjust. Home values across the Phoenix-Mesa-Chandler metro are down more than 10% year over year, and since late 2024, nearly 87% of homes have lost value. That's not a brief slowdown. It's a market-wide contraction. For more than a decade, Phoenix ran on one primary fuel: migration. That engine has stalled hard. Net domestic inflows collapsed from about 32,600 people in 2022 to fewer than 2,000 in 2024, snapping a 13-year streak of population growth. When population growth stops, housing momentum doesn't gently fade. It breaks. Builders didn't slow down in time. New construction kept coming, and inventory surged to nearly 15,000 active listings, up from roughly 10,000 just a year earlier and almost 4 times the pandemic low. At the same time, affordability has cracked. The median home price still sits around $430,000, but even after recent declines, mortgage payments are about 70% higher than they were in 2019. Ownership costs are adding more strain. Utility expenses are climbing, with summer electricity bills now regularly hitting $350 to $400 per month, an extra burden that cooler markets simply don't face. Long-term concerns around water supply are no longer theoretical either. Those risks are increasingly being baked into insurance costs and underwriting assumptions. Investors are backing out quietly. Short-term rental supply has ballooned, rents are flattening, and vacancy rates are rising. Price reductions are spreading across suburban neighborhoods that were once defined by bidding wars. Nearly half of all listings have already cut prices at least once. Phoenix never had a strong price floor built on income growth. It had a ceiling built on migration. Now that migration has reversed, the math is unforgiving. More homes, fewer buyers, and higher costs. Markets don't debate that equation. They follow it. Number 2. Austin, Texas. Austin's housing market didn't simply cool down. It shattered the story it was built on. For years, this city was held up as proof that real estate had entered a new phase. Prices would only rise, tech workers would keep pouring in, and demand would stay permanently elevated. Every one of those assumptions is now unraveling at the same time. Since peaking in 2022, home values in Austin have fallen by more than 14%, placing it among the steepest declines of any major U.S. market. Typical prices have slid from the mid-$500,000 range to roughly $430,000, erasing several years of gains in less than 3 years. Even more telling, Austin posted the largest month-over-month price drop among major metros in late 2024, a clear sign the market didn't find a floor, it rolled over. Inventory tells you why. Active listings have more than doubled compared to the pandemic years, overwhelming a market that was once defined by scarcity. Homes that used to sell in a week or two are now sitting for 75 to 90 days, forcing sellers to cut prices just to stay visible. More than 45% of listings have already lowered their asking price, and many have done so multiple times. The tech narrative is weakening as well. Layoffs, hiring pauses, and return-to-office mandates are shrinking Austin's buyer base. At the same time, ownership costs keep climbing. Property taxes in Travis County jumped between 20 and 30% after reassessments, pushing monthly payments higher even as home values fall. Insurance premiums and HOA fees have followed the same upward path, quietly squeezing affordability from every angle. Builders are showing stress first. Incentives on new construction are now running 8 to 10% of the purchase price, including rate buydowns and outright discounts. That's not confidence, it's excess inventory. And when builders start cutting, resale sellers inevitably follow. Austin didn't stumble because the city stopped functioning economically. It fell because expectations raced far ahead of reality. Prices were set for a city still growing at pandemic speed, even as migration slowed and high-income job growth softened. Momentum-driven markets don't move sideways when demand vanishes. They reset hard. Austin is still trying to find a price level buyers actually trust, and history suggests that process rarely ends gently. Number 1. Cape Coral, Florida. Cape Coral isn't just struggling, it's currently the clearest case study in the country of what happens when speculation, climate exposure, and rising ownership costs collide all at once. This market isn't easing lower, it's coming apart. Home prices in Cape Coral are down more than 6.5% year over year, while the national average is still showing gains of around 2%. That kind of divergence alone should be flashing warning lights. But the most alarming data point isn't the price drop, it's the destruction of equity. Nearly 8% of homeowners in Cape Coral are already underwater, owing more on their mortgages than their homes are worth. That's the highest share anywhere in the U.S., and it didn't take a decade to happen. It unfolded in less than 2 years. Home values fell from roughly $395,000 in late 2023 to about $372,000 by the end of 2024, wiping out years of appreciation almost overnight. Supply is overwhelming the market. Listings for sale have surged close to 38% year over year, jumping from about 8,400 homes to more than 11,600. At the same time, buyer demand is evaporating. More than 52% of active listings have already cut prices at least once. That's not strategic negotiation, that's sellers scrambling. Then there's the cost shock. Insurance in Cape Coral has become crushing. Average homeowners' insurance premiums now exceed $5,000 per year, and waterfront properties are seeing quotes well into 5 figures. Hurricane Ian permanently rewrote underwriting assumptions. Insurers aren't pricing for normal risk anymore. They're pricing to survive. For many buyers, coverage either isn't available or doesn't make financial sense at any price. The luxury segment reveals just how deep the problem runs. A waterfront mansion that initially hit the market near $12 million was slashed to $8.9 million, a $3 million hit in under 2 years, and it's still struggling to find a buyer. When high-end buyers retreat, confidence drains from the entire market. Cape Coral was marketed as both a retirement haven and an investor's dream. Instead, it turned into a leverage trap. Rising insurance costs, falling prices, and swelling inventory feed into each other, creating a self-reinforcing downward spiral. This isn't a correction waiting in the wings. It's capitulation already underway. And once forced selling accelerates, there's no safety net, only the math.